parking?
Yeah. Well, it's a terminal parking, though.
Terminal parking always expensive.
Yeah.
And that's because they're not looking to force past the trees.
Yeah, terminal parking, you only want 1 hour.
Huh?
Terminal parking, you want to park 1 hour only.
Whole day is $42.
Whole day, you go to long term.
Yeah.
I want to switch it back.
You listen?
Yeah.
To obsession either way. It's almost like everyone's going to say, see, I was right. See, we were slowing, they shouldn't have tightened. See, they should have tightened more, and then we wouldn't have to slow this much. You know what I'm saying? I mean, this is going to be, it's going to be, I think the markets are trying to even figure out what's up and what's down.
Well, it's because, this is the most complicated situation that we've ever seen in our lifetime. I mean, we have a shooting war in Europe, coupled with an ongoing pandemic, and maybe in the U.S., Canada, we're starting to live life again, but that's not the case in China, where they shut down, port cities with billions of people, it seems like every couple of weeks, which has a huge impact on global supply chains. So it's a very complicated situation right now. And so I'd say that, we got these exogenous price shocks. We can go back and talk about how strong demand is. It actually is not about how strong demand is. Real GDP, which is demand in the economy, people don't realize that when you look at the monthly GDP numbers, Kelly, they're running negative 2.4% from October to March. Like, the recession is probably already starting.
That's
now,
good. Yeah. It's a good There's good buses here. I know.
Yeah, take off.
But the question is, the 3 month at some point will catch up to the Fed funds rate. I don't think that's a meaningful indicator. The meaningful indicators, if you're taking a look at what the cyclicals, the relative strength of the cyclical stocks in the S&P 500, they're telling you a very significant story that is not consistent with a bullish theme from a steep yield curve benchmark from the 3 month Treasury bill. But the bottom line here is that we have this massive exogenous price shock. It is no longer a demand story. That was the inflation last year. That was the demand story and the supply story. It's just that the supply curve globally continues to shift to the left. And now you've got central banks saying, enough is enough. We are now going to start to have to offset that by shifting the demand curve to the left. And that's how you get the recession. And actually, I would say that most people calling for a recession, well, they'll tell you, Kelly, it's a 35% chance. So that way, if we get it, well, I did say 35%, or they're saying it's next year's story. No. It's actually already in the data, especially if you look at real incomes that ultimately drive real spending. Real incomes in the United States, negative 7 of the past 8 months.
I'm just saying, if they tighten sooner, then real incomes wouldn't be as bad.
Well, that's what I mean. Well, no, I agree with that, Kelly. Look, you're caught between a rock and a hard place. If this was inflation.
Yeah.
Okay, it was inflation caused by demand, that'd be one thing. So you get the inflation shock, and now we're going to get the interest rate shock. Either way, we get a recession out of it.
Exactly. On that note, Dave, thank you very much. It's good to see you today.